Welcome back to Joseph Markets. If you have been paying any attention to the financial markets, the commodities sector, or your own investment portfolio over the last few months, you know that we have just witnessed one of the most historic, chaotic, and unprecedented wealth transfers in modern history. I am talking, of course, about silver. Just weeks ago, silver did the impossible. It shattered the psychological barrier of $100 an ounce, climbing all the way to an astonishing $120. Retail investors were cheering, institutional funds were scrambling, and the media was calling it the unstoppable supercycle of the decade. But then, as quickly as the rocket took off, the engines failed. In a matter of days, silver prices plummeted by nearly 40%, crashing down toward the $75 mark. Trillions of dollars in paper wealth were wiped out in a flash. Portfolios were decimated. Margin calls echoed across Wall Street. So what exactly is happening behind the curtain? Why did silver experience a meteoric rise that defied all expectations, and why is it currently bleeding out on the trading floor? More importantly, we have to ask the ultimate questions. Is this crash going to continue? Are we heading back to $50 an ounce, or is this the absolute perfect moment to back up the truck and invest? Today, we are going to strip away the noise. We are going to look at the raw data, the institutional movements, and the geopolitical chess pieces that are manipulating the price of this precious metal. I am going to break down the exact reasons for the rally, the hidden triggers for the crash, and give you a comprehensive roadmap for what happens next in 2026. But before we dive into this massive market breakdown, I need a quick favor from you. If you want 100% true news, transparent data, and highly accurate financial advice that you can actually trust, hit that like button right now. Subscribe to the channel so you never miss an update, and go down into the comments section and type Joseph Markets. Your support tells the YouTube algorithm that this is the real, unfiltered financial truth, and it helps us continue to bring you these deep dive analyses, like subscribe and comment Joseph Markets right now. All right, let's get into the data. To understand why silver is crashing right now, we first have to understand why it exploded in the first place. You cannot diagnose the fall without analyzing the climb. The late 2025 and early 2026 silver rally was not a fluke. It was not a random meme stock phenomenon. It was the result of a perfect storm of macroeconomic forces, industrial demand, and geopolitical panic. Point 1. The structural supply deficit. Let's start with the undisputed facts. According to the 2026 Precious Metals Investment Report by the Silver Institute, the global silver market is currently experiencing its sixth consecutive year of a structural supply deficit. This means that for 6 straight years, the world has consumed far more silver than we have mined or recycled. The deficit for 2026 alone is projected to be a staggering 67 million ounces. When you have a commodity where the global demand constantly outstrips the global supply year after year, the above-ground stockpiles begin to drain. Institutional investors finally woke up to this reality. They realized that silver is not just a shiny rock used for jewelry, it is a critical, depleting resource. Point 2. Industrial demand on steroids. Unlike gold, which is primarily driven by investment and central bank hoarding, almost 50% of all silver supply goes directly into industrial applications. And not just any industries, the industries of the future. The aggressive expansion of solar photovoltaic panels, electric vehicles, and AI-driven data centers requires immense amounts of silver. Silver is the most conductive element on Earth. There is no green energy revolution without silver. In 2025, EV-related silver demand jumped by an estimated 20%. As our world becomes more electrified, the demand for high-voltage wiring, sensors, and power management systems skyrockets. Investors saw this industrial supercycle colliding with a supply deficit, and they bought in heavily. Point 3. The China export shockwave. But the real catalyst, the spark that ignited the powder keg and sent silver soaring to $120, was geopolitical. Late last year, China, which is one of the world's largest refiners and exporters of silver, made a shocking announcement. They revealed plans to heavily restrict their domestic exports of silver starting January 1st, 2026. China reclassified silver as a strategic material necessary for their own technological and defensive supply chains. When the world's second-largest exporter suddenly says they are turning off the tap, panic ensues. This stoked immediate fears of a massive global supply shortage, triggering a parabolic acceleration in silver's price as Western industries scrambled to secure their inventory. Point 4. Macroeconomic fear and safe haven buying. Alongside these physical market dynamics, we had a paper market driven by fear. Throughout 2025 and into early 2026, investors were terrified of shifting U.S. policies, rising national debt, and geopolitical instability in Eastern Europe and the Middle East. People bought silver because they were losing faith in fiat currency. It was the ultimate inflation hedge and safe haven asset for the everyday investor who felt priced out of gold. All of these factors combined created an unstoppable upward momentum. But as history shows us, whenever an asset goes parabolic, the pendulum eventually swings back with violent force. So we hit $120. The champagne was popping, and then the floor fell out. We are now looking at a massive 36 to 46% correction depending on the trading day. Why is silver bleeding? The answer lies in the mechanics of the financial markets and shifts in global liquidity. Point 1. The margin call massacre. The most direct trigger for this massive crash was institutional intervention. When silver prices surged by nearly 100% in a matter of months, the volatility became extreme. In response, major commodities exchanges, including the CME, officially hiked their initial margin requirements for silver contracts. In early 2026, the initial margin for a silver contract jumped dramatically to $25,000. This was a deliberate move to cool down an overheating market. But it had a devastating side effect. Smaller traders and retail speculators who did not have sufficient capital to meet these new, massive margin requirements were forced to close their positions. This triggered a cascade of automatic liquidations. As forced selling hit the market, the price dropped, which triggered even more margin calls, creating a vicious downward spiral. It was a classic long squeeze. Point 2. The Lunar New Year liquidity vacuum. You cannot discuss global commodities without discussing Asia, and specifically China. In February 2026, the global bullion trade experienced what analysts call a liquidity vacuum. Major Asian markets, including mainland China, Hong Kong, Singapore, and Taiwan, shut down for the Lunar New Year holidays. The Shanghai Gold Exchange and the Shanghai Futures Exchange are critical hubs for price discovery and physical demand. When they closed their doors for the holidays, a massive chunk of global buying pressure simply vanished. With reduced trading volume and thin liquidity, it took far less selling pressure from the West to drive the price down drastically. Thin markets are volatile markets, and the sellers took absolute control. Point 3. The resurgence of the U.S. dollar. Silver, like all commodities, is priced in U.S. dollars. There is an inverse relationship between the strength of the dollar and the price of silver. Recently, we have seen a rebound in the strength of the U.S. dollar index. Why? Because the market began to reevaluate the Federal Reserve's interest rate path. Investors realized that inflation might be stickier than expected, meaning the Fed might keep interest rates higher for longer. Higher interest rates make yield-bearing assets like Treasury bonds more attractive compared to non-yielding assets like silver. As foreign buyers found silver more expensive due to the strong dollar, global demand softened, pulling the price down further. Point 4. Profit booking and bubble psychology. We also have to acknowledge basic human psychology. According to quantitative models from major banks like Societe Generale, the silver market in January had entered bubble territory. The price action had become entirely disconnected from the physical fundamentals and was being driven purely by speculative greed. When you have institutional investors sitting on 70, 80, or 100% gains in a matter of months, they are going to take profits off the table. As the big players started cashing out at the top, the momentum shifted, leaving late-arriving retail investors holding the bag. Point 5. easing geopolitical tensions. Finally, the fear premium began to evaporate. Recent weeks in 2026 saw new diplomatic talks, including discussions regarding Ukraine and potential nuclear deals with Iran spearheaded by the U.S. administration. As geopolitical risk sentiment improved, the desperate need for safe haven assets diminished. Investors began moving their capital out of precious metals and back into risk-on assets like equities. Now we arrive at the most critical part of this analysis. The past is the past. What you need to know is what happens tomorrow, next week, and next month. Will silver continue to crash, or have we found the bottom? Let's look at the technical and structural forecasts for the rest of 2026. The technical support levels. Currently, silver is trying to establish a firm floor. Technical analysts are looking very closely at the $70 to $75 range. This zone acted as major resistance during the climb, and in technical analysis, previous resistance often becomes future support. If silver can hold the $75 line, this entire crash will be viewed historically as a healthy, albeit brutal, market consolidation, a necessary shakeout of weak hands and leveraged speculators. However, if the US dollar continues to strengthen and the $70 floor breaks, technical models suggest we could see a further slide down to the $60 or even $55 range before long-term institutional buyers step back in. The threat of industrial substitution. There is a massive long-term risk that nobody on YouTube is talking about, and you need to hear it. Remember how we said solar panels require massive amounts of silver? Well, capitalism is highly efficient. When the price of an input material like silver skyrockets to over $100, solar panel manufacturers panic. Their profit margins get destroyed. According to analysts at J.P. Morgan, sustained sky-high silver prices will force industries to accelerate thrift, meaning they will engineer ways to use less silver per solar panel. Worse yet, it accelerates the adoption of entirely silver-free technologies, like cadmium telluride thin film tech. If silver stays too expensive for too long, it might permanently destroy a portion of its own industrial demand. The macro environment and the Fed. The path forward for silver is heavily dependent on the U.S. Federal Reserve. If the U.S. economy shows signs of a recession in late 2026, the Fed will be forced to slash interest rates and print more money to stimulate the economy. This would instantly devalue the dollar and send silver prices skyrocketing back toward previous all-time highs. Conversely, if the economy remains robust and the Fed holds rates steady, silver will struggle to regain its explosive momentum and may trade sideways in a frustrating, volatile range for the rest of the year. The return of Asian demand. We must also watch what happens as the Asian markets fully reopen and digest this price drop. The Shanghai premium might return. With prices down nearly 40% from the peak, Chinese industrial buyers and retail investors might view this as a massive discount and rush in to buy the dip, providing a sudden influx of bullish momentum. So here is the million-dollar question. Is right now, today, a good time to invest in silver? The answer is, it depends entirely on your time horizon and your tolerance for pain. The bull case for investing now. If you are a long-term investor with a time horizon of 3 to 5 years, this crash looks like a gift. According to the Silver Institute, the structural deficit is not going away. We are still going to be short by nearly 67 million ounces this year. The green energy transition is not stopping. AI data centers are being built at a record pace. The physical constraints of mine production mean we simply cannot pull enough silver out of the ground to meet the needs of the 21st century. When you have an asset with finite supply and mandatory inelastic demand, the long-term price trajectory mathematically has to be up. Buying a vital global resource at a nearly 40% discount from its recent high is a classic value investing play. The bear case and words of caution. However, if you are a short-term trader looking to make a quick profit next week, you need to be extremely careful. Silver is famously nicknamed the devil's metal for a reason. Its volatility is legendary. It can and will wipe out over-leveraged traders. The current market is still heavily influenced by paper contracts, algorithmic trading, and macroeconomic data drops. We could very well see more downside volatility before a true bottom is cemented. If you choose to invest, the smartest strategy is dollar cost averaging. Do not throw all your capital into the market on a single day. Buy a little bit this week, a little bit next week, and slowly build your position. This protects you against sudden daily drops and ensures you accumulate a solid average price over time. Furthermore, owning physical silver, actual coins and bars, removes the counterparty risk associated with paper contracts and margin calls. The silver market of 2026 has been a roller coaster of historic proportions. We saw the highs of euphoria and the depths of panic. But as investors, we do not operate on emotion. We operate on data, supply and demand fundamentals, and macroeconomic reality. Silver remains one of the most essential, undervalued, and strategically important assets on the planet. The paper markets may manipulate the price in the short term, but physical reality always wins in the end. I want to thank you for sticking with me through this deep dive. Navigating these markets is not easy, but you don't have to do it alone. If you found value in this breakdown and you want to ensure you are always getting 100% true news and accurate market advice, you know what to do. Hit that like button right now. Make sure you subscribe to the channel and drop a comment below saying Joseph Markets to let me know you are part of the smart money community. Let me know in the comments. Are you buying the silver dip or are you staying away? Until next time, keep your emotions in check, protect your capital, and stay sharp. This is Joseph Markets, signing off.